Let's welcome in our next guest, Mahantesh Sabarad, Deputy VP Research at SBICap Securities. Mahantesh, you tend to get always a sense about the flows in the markets and what's happening. Can you just tell us what's happening in the retail side of the market? We are seeing 10%, 12% sort of moves coming in. Is retail participation increasing and institutional participation is broadly flat?
Yeah, that seems to be the case. Okay, there are three kinds of investors, broadly speaking. One is the retail kind of investor, which includes the HNIs, and there is also the DII institutional investors, and there are the FII institutional investors. If you look at the flows, and this fiscal year particularly, the retail flows have been very strong and robust. DII flows have just about been 1% in terms of their, and there are two parts. There is a flow and there is a turnover that they achieve. Flow is what they receive in terms of their funds inflow, but what they do in terms of their turnover deployment, that is very weak. FIIs continue to remain quite strong in terms of their movement, but it is still short of what the retail investments and deployments is there in the market.
Right, so it's mainly retail and HNI category which is driving the recent moves.
Yeah, I would tend to think so, and I would also partly attribute it to a little bit of ETF inflows that have been coming into the market. So the markets are going up based on money which is not of a long duration, long maturity kind of money. Right. ETF is a short maturity money. Retail investor is a finicky investor. He or she will sell pretty quickly.
Right. Can you also just talk to us about after the recent run-up, are we, likely to see a correction in terms of valuation, but the correction may be short-lived because still the liquidity is high?
Yeah, I think you are right in terms of your assessment. Okay, one part you of course alluded to is the valuations. The markets are at very high valuations now, so therefore you don't really feel very comfortable with the market going further up from these levels. But as far as liquidity is concerned, since the liquidity is very high right now, you will see very short. You will see corrections, but which are either of short duration or of short magnitude. So I think the markets are therefore going to be positively biased for the coming few months unless we see a reversal of the flows from now onwards.
Right. Let's go towards names and stocks that probably, is something that, could do well. You like a JK Tyre. What was the target and what's the call over there? We have seen tire companies doing well, but most of the companies like Apollo Tyres have come out and said that, margins may not be the same because of prices going up.
So JK Tyre is a stock that we like. We have put out a target price which is about 141 rupees right now. And the key thing to note here is JK Tyre business is moving on a different trajectory unlike the other tire companies. And what I mean by that is JK has recently acquired the Kesoram's unit, which is internally called as Cavendish, and therefore they are seeing a large growth, inorganic led growth that is happening. At the same time, their margins are improving because that unit comes with its own benefits, tax benefits, etc. So therefore you also see in terms of the stock performance, JK Tyre has handsomely outperformed many of its peers like CAT, Apollo or MRF in the past few odd months because of this whole improvement in Kesoram coming in. And moreover, there's another trajectory that JK Tyre is embarking upon, which is sale of two-wheeler tires. Hitherto, until now, JK Tyre was not into two-wheeler tires. Now they are into two-wheeler tires as well. That's a high-margin product for them. It's a high-margin product, generally speaking, for the entire industry. But for JK Tyre, it's a welcome business change. So these are the things that make JK Tyre a little more attractive relative to the other tire players.
Right. As far as tire industry is concerned, do you expect pricing discipline to be there in the industry? Because, if a person is losing market share, say probably in the two-wheeler space, who has the current good market share now, would come out and start to reduce prices. And they have the margin benefit because crude is still on the lower side.
So there are two parts. One is pricing discipline. The way we notice it is there seems to be a pricing discipline among the domestic players. And there is a pass-on effect that is happening simply because the crude prices and other cost items are coming down. Therefore, tire prices naturally will be on the downtrend. But more importantly, what is actually disturbing the pricing discipline is the imports of Chinese tires into the Indian markets. Fortunately, imports are coming in specifically in certain segments, which is largely commercial vehicle tires and utility vehicle tires. Not really so much on two-wheeler tires, or not so much on passenger vehicle tires, or passenger car tires, etc. So this element of discipline, which is sort of being negated by the Chinese tire imports, obviously is hurting the entire industry, and will hurt even a JK Tyre in the short term. But what we foresee is that Chinese tires are the loyalty that we see in the market for tires is absent for Chinese tires among customers. So we don't see it as a sustainable growth for Chinese tires if I were to take a 3-year, 4-year kind of view.
Mahantesh, good afternoon. This is Anindya from the Delhi studio. It's actually still not afternoon, still morning. JK Tyre, increasingly the tire business is quite heavily dependent on not just rubber but also on the crude basket, right? Now, are you confident that crude prices will more or less remain where they are and costs will not increase?
Okay, Anindya, there are two parts. Tire business have traditionally been very crude dependent. In fact, natural rubber prices, although they are different from crude, they are not crude derivatives, but natural rubber prices tend to follow the demand dynamics linked to crude oil globally. Yeah. So therefore, tire companies have traditionally, or that's the business structure, have been exposed to the variations and fluctuations of both crude oil as well as natural rubber. Having said that, what has changed in the Indian market is 2 or 3 things. One, there's a huge radialization effect that is playing on in India, which is on the commercial vehicle tires. We are already 100% radial when it comes to passenger vehicle tires, almost 100%, I would say. So radialization is picking up in commercial vehicle tires. That gives a pricing advantage. So the ability of tire companies to price is better, and therefore their ability to sustain the shocks of costs related to crude and natural rubber is more. Number 2, there's a huge market that is now growing for two-wheeler tires. So two-wheelers have been growing consistently over the years. There's a huge population. The usage of two-wheelers is going up, and therefore the consumption of two-wheeler tires is also going up. And these are high-margin business for tire companies. They are not only high margin, they're also high volume business. So this is the second thing that is changing for the industry. And the third thing that you will notice is in the last 5-7 years, most of the tire companies have put in new capacities, which are far more efficient than the earlier older capacities that they used to. So there are productivity improvements that are coming in, and cost structure per se is becoming a little more leaner. So I would attribute that the tire industry is structurally changing for all these things, and there could be a possibility, the fourth benefit that can come in the form of anti-dumping duties on Chinese tires. So that's something that the industry has been fighting for.
Right. But, between MRF and JK, let's say, that I'm just looking at the kind of multiples that they're trading at. Why is the market right now paying half what it is willing to pay MRF?
You look at the balance sheet now, that's the interesting part. You have JK Tyre, which is among all the tire companies continue to have a high level of debt. Yeah. The debt equity is close to 1.6, 1.7 times right now as I speak to you on a consolidated basis. So therefore,
but if I look at interest coverage, EBIT to interest cost, it's almost 3.5, 4 times. So it's not as if it's not being able to pay back that debt.
No, they have. I think they have the ability to pay back the debt because of the recent quarter performances, where we will notice that there is a sudden uptick in their margins for them. So you asked me a question, why is JK Tyre trading at a cheap valuation relative to an MRF, and the reason has to do with the indebtedness of the balance sheet. Over a period of time, as JK Tyre also becomes cash rich and cash surplus like an MRF tire, you will see similar multiples coming back. The other aspect is MRF tire were the leader in the two-wheeler, three-wheeler tires in the past. That leadership is now threatened by the likes of a JK Tyre, is threatened even by the likes of an Apollo Tyre, who is also getting into two-wheeler tires. They are currently outsourcing those tires. They're not manufacturing in-house. So I think you will see an element of catch-up in terms of valuations happening for JK Tyre over a period of time, and that period of time will be like 2-3 years till the debt comes down.
What kind of ROC, what kind of return ratios is it working with, JK Tyres?
Still very high. So JK Tyre's return ratios are close to that 16 to 18 multiples, 18%.
All right. Let me move a little bit from tires. You were saying, you were telling Pankaj that how the current rally has been heavily driven by retail participation. What is on the ground, what is happening in brokerages? I would be interested in that. When retail comes in, sometimes they move through brokerages. Are those businesses doing well? Are more people being hired? I'm not looking for a job, just to make it clear. But, one had heard that there was a bit of a stress. Is that period over?
No, I don't think there is a stress building up in the retail brokerage businesses lately. Many of them are doing really well. I wouldn't have the statistics in terms of the hiring
just what you would pick up from the market grapevine. Are there people, are people being poached from your team and stuff like that? Is it happening? Obviously not just brokerages. You look at the analysis part. But I'm just saying that, would you buy brokerages, for instance, some of them which are listed?
Yes, you can buy some of the listed brokerages in the market, because I think they are doing relatively better. Over a period of time, they have also diversified their businesses beyond just pure broking, and therefore that makes it a lot more attractive. So to answer your question, yes, one should be looking at retail, the brokerages stock that are listed on the markets. I have not done a study in terms of which looks attractive, which set of stocks look attractive, which set of stocks don't look attractive, but I'm generally speaking about the industry per se.
Okay, let's move to one of your picks, that's Granules India, I understand. API, largely an API maker, right?
Yes, it is largely an API player, but now there are certain changes there are business changes that you can notice in the company.
Okay.
They have this now joint venture with OpeningCon. There is a huge supply growth that will happen. They are gradually getting into, they're no longer an API player, they're also getting into ANDA filings.
Okay.
And therefore the outlook for that, for Granules India looks far better right now.
And what are the numbers looking like there?
So firstly, let me state that the target price that we have is 156 rupees. The growth rate, you asked me in terms of numbers, then we are looking at an overall business growth CAGR somewhere in the mid-20s in terms of their top line growth, or even I would say late 20s. So there's a huge top line growth that we are seeing, and therefore the growth will be far better when we look at the bottom line numbers.
But I'm just trying to look at the numbers for Granules India in terms of debt and stuff like that. Now, what is its current debt position? Because I was looking at the ROC and didn't look very interesting if one had to pull out companies on the basis of kind of returns they're giving on capital employed.
So the debt is not a very challenging number. I think it is well under control. It is less than 0.5. So for a pharma company, normally you don't associate pharma companies having large amount of debt. But what I'm essentially trying to tell you is that debt is not a challenge. What is the story for Granules? It's all about growth. Growth in through its JV, growth in the ANDA portfolios for them going forward, and the traditional growth that they have been doing. So they're getting into value-added products, fixed dosages, for example. So these are the things that Granules India will do better in the oncoming years.
All right, and that is your pick in a kind of a pharma supplier zone, plus also you're saying that they're filing their own.
Yeah, generally the pharma space has not been doing well lately in the market, you would have noticed, and most, including our broking calls on the major pharma companies has been either the hold kind of calls or a dovish kind of outlook for most of the pharma companies. So the large cap pharma companies exposed to the US markets are facing tough challenges, and therefore we don't like the larger pharma space. So you have to be very choosy in terms of what stocks you look for within the pharmaceutical space.
All right. Your third call, I understand, is Nandan Denim. Now, what little I know about that company, it's a specialty denim manufacturer, right? It creates different kinds of specialized denim, which it then supplies. Is it a customized denim manufacturer?
It is not really a customized denim manufacturer by that logic, what you are saying, trying to say, but it has its own niche in terms of the customer focus that they have. So they are a denim player. What is good about the stock, or why we like the stock, are a couple of things. One is there is backward integration. They are getting into yarn manufacturing of their own. So that should mean when they capture more of the value add, their margin should therefore grow. Without a commensurate top line really growing. Second is they have still unexpired VAT benefits that are will continue to accrue to them. So therefore, again, margin accretive for them. And thirdly, I think their focus is growing more on the exports now. Exports, if I'm right, was about 12% of their revenues. It is gradually building up to become 15 to 16 now. So that's how we foresee in the years ahead. And that's where what you termed as a specialty denim manufacturer comes into play.
In the sense that if I had read somewhere that they, Armani Exchange, Ralph Lauren, they specifically ask for types of denim or a design of denim, and Nandan is able to supply that. That's what, maybe I'm wrong. I may be confusing with some other company.
I'm not aware of such details as you are telling me, but yes, they are a leading denim manufacturer, and some of these customers that you name are their clients.
Right. Mahantesh, anything else that you have as a pick? We got 3 from you. Anything else that, or is everything looking a bit too expensive right now?
It is looking very expensive. The overall market is very expensive, and I was, looking at the kind of calls that we give. We have very few in the entire universe that we cover now. Very few buy calls, and gradually there are a few sell calls that are coming into our recommendations now.
Right.
The moment you have, so the trade-off between valuation and outlook is becoming worse, is worsening by the day as the market goes up. So it's very difficult to,
And even the global triggers seem to be changing every day. One day you get a number which says US GDP is growing very fast. The next day you get something which says exactly the opposite.
Yes, the global economic situation is in a flux. Really, we don't know where the globe is headed to. US seems to be having a great deal of recovery, but that's only in relative terms to its own poor performance of the previous years. Look at Japan, for example. Again, we don't know what's really happening in terms of the Japanese economy. Look at China. We don't know when we used to talk about this whole credit bubble burst, but China is still not performing. One look at the commodity offtake that China is doing, and it tells you the story. Look at Europe. It has its own problem with Brexit now already put in place. So all in all, I think the global economy doesn't seem to be standing on a sound base right now, and therefore it's becoming difficult in terms of the outlook. Look at the IT companies. You asked me, are there any picks? In fact, one would say that the kind of stock fall that we have seen, stock price falls in the IT space.
I was just going to ask you about Infosys actually.
Lessens the it just at least lessens the outlook versus valuation trade-off.
Yeah.
So it becomes a little more favorable for IT companies now. So outlook is not really strengthening, but the valuations are weakened. So some of the stocks then therefore appear attractive.
Because if I look at Infosys, all right, it's dependent on the guidance they've given, but right now FY18, I think the PE would be what, 14 and a half. Now, for a company which gives you that kind of cash, right, it looks pretty cheap.
Yes, you are right. I think it is very cheap. It is.
It is very cheap. But so would you put out a buy call on Infosys at all?
We have a buy call incidentally on Infosys.
Oh, all right. Okay.
And unfortunately, the recent news flow for the stock has not been too good. The whole Brexit fear now,
which is actually great, right? Which is actually great, right? I mean, if you go by what all the gurus of stock markets say, it's good to have some bad news in a fundamentally good company because then you get it cheap.
Yeah, it's a good entry point, I would say. You put it rightly. For such a company of such high caliber, whenever you find weakness in those stocks, that's the right time to buy. Look at even FMCG companies. The only time that the FMCG companies look attractive is when there is some element of stock fall. Otherwise, they will continue to be those 35 multiple stocks or 40 multiple kind of stocks. FMCG stocks will never sort of, and I'm talking about large MNC, FMCG kind of companies.
Yeah.
The only time that you get an entry point in these stocks is when you have a correction of the magnitude of 5 to 10% spread over 5 to 10 days.
Yeah.
That's the right time to get into FMCG stocks.
Right. Mahantesh, thank you so much. I hope you come back soon because we have a lot to discuss with you. Thanks a lot. We've taken a lot of your time. Pleasure talking to you as usual.